Hi, and welcome to our LinkedIn Live series on the release of the ISM Report on Business. My name is Dan Zeiger. I'm a writer and copy editor for Inside Supply Management. That's Institute for Supply Management's member publication. We're happy to have you with us today as we discuss another interesting month with the Services PMI data. And you don't need me to tell you it's been a turbulent day on market floors, so we've got a lot to talk about. The composite index reading was 51.4%, and that was boosted by expansion and business activity, new orders, and for the first time in 6 months, employment. The data was a ray of sunshine amid sell-off data in markets globally, based in big part on economic data last week, including ISM's manufacturing PMI that was considered disappointing. So let's get into it, and we'll bring in Steve Miller. He is the chair of the ISM Services Business Survey Committee. Steve, it just was an interesting reading, as we've talked about and people have talked about all morning. I mean, a positive reading in July, which I know is good, but it's also teeter-tottered if you talk about the Services PMI between expansion and contraction for the last 5 months. I know that's not an ideal situation either. Just talk about, what you saw in the July data and recent trends and what stands out to you.
Sure. Thank you, Dan. So overall, I mean, it seems like what we're moderating. It was slow growth is what the number indicated, with some welcome bounce back on the specifically on the orders and the business activity. It's kind of in line with the year-to-date level of slow expansion. We'll wait, we're up and down and up and down, and up for the last 4 or 5 months. So we'll wait and see how things go. But it seems like, listening to some of the earnings reports recently of not hitting growth expectations, either on the top line or the bottom line. And what we're seeing is moderated growth. It seems to be consistent, at least from a novice's perspective. Yeah,
I know. By my count, the last 3 times the Services PMI has contracted, I mean, it's been basically a one-off. I mean, I know you weren't the chair for all 3 of those, but based on your opinion, and what about how the data works and how the services sector works, any reason why that could be?
Well, what was interesting, kind of aligned with that question, Dan, is that what we saw when we looked through the data and the percentage of the GDP that's represented by the industries reporting, we're just slightly positive. So 3%, if you look at the weighting of GDP for the contracting versus expanding, 3% more on the expanding side. So although their ratings overall could be much higher or much lower than 50, when we look at the core contribution to GDP across those industries, we're not far away from contraction this month. So I would say, not out of the woods, but we can see the grasslands outside of the woods. We're pretty close, or we're right at the edge of the woods, just outside of the woods.
Yeah. Well, let's expand on that a little bit. You had discussed this, I know, on an interview earlier today, where you kind of broke down, which of the services industries had a good month and which of the services industries were still struggling. Obviously, as we wait for some clarity on interest rates, the real estate rental and leasing, that's one of, the biggest in the sector. And that's still going to be treading water for a little bit, but you discussed some of the other ones. And they tended to be a little bit more of the smaller industries, that had a good month. Finances and insurance is one of the bigger ones. It had a good month, so that was an exception. But, some of the industries that had a good month in July were some of the smaller ones when you talk about contribution to GDP. Just expand on that a little bit, and just also in the context of as we wait for what the Fed might do on rates, as we talked about the impact on real estate rental and leasing. Just kind of break that down a little bit.
Okay. So I'm going to be looking up at a chart.
I do it too. Don't worry about it.
Overall, from the last GDP numbers, 89.68% of GDP comes from the services industry. In the latest report, 45.5% of GDP was in growth, and 44%, just over 44%, was in contraction. So overall split. And to your point, Dan, real estate, rental, and leasing, second month in a row in contraction. The next largest is professional scientific and technical. That went from expansion to contraction. Next one is healthcare and social assistance. That stayed for the fourth month in a row at expansion. But then the next one up is information, and that went from actually contraction for 3 of the last 4 months, the last 2 months. So definitely seeing that larger side. But then public administration, transportation, warehousing, utilities, mining, management of companies, finance and insurance, construction, arts, entertainment and recreation, and accommodation to food services, all positive. So like you said, 2%, 1%, 3%, 5%, all adds up to a little over 45. Yeah. Second half of your question.
Oh, the impact on interest rates. I mean, we could, I'm sure we could talk about that for the rest of the time, but I just from a couple of the respondent comments. I mean, obviously they mention them, and obviously it would be a boon to the sector if we were to get some clarity on that. Wasn't as overt as I noticed in the respondent comments as in previous months, but obviously it's something that's on a lot of purchasing managers' minds. Just talk about it. Everyone's going to look at a piece of economic data and think what the Fed might do with it. So just talk about it from that perspective as well.
Yeah. So when you look at real estate, rental, and leasing, a lot of capital investment, and we've seen that be negative for the last 2 and 3 out of the last 4 months. It may go back negative beyond that, but I just looked at the last 4 months. When you look at mining, though, construction and utilities, all positive this month. I don't know whether that's order flow starting and optimism around being able to do investments and what it'll cost to carry that investment. But with some of the weakness or potential weakness on the AI side, not shrinking, but not growing quite as fast as optimism would say. I wonder if that will impact cash flow into utilities and construction, because we saw a little commentary on data center investment as well. So for me, those are the ones that kind of stand out the most.
Yeah. Well, obviously we're now in the second half of the year, and as you pointed out, the data has indicated there have been a couple of contractions, but the data has generally indicated growth, not great growth, but more moderate growth for the sector. Just kind of give us your big picture. I know last month a quote to me that stood out was, someone asked you if there was any positive signs in the data, and you said, I wish I could find any. And, we got a little bit, that's not necessarily contradictory, because, this was a positive reading, but I mean, it wasn't gangbusters by any stretch of the imagination. Just talk about that moderate growth that we've been seeing in the sector over the first half of the year, and just what it could mean big picture, for the second half.
Yes. So when you look at through the year thus far, we're at about Services PMI 51.5%. That's the lowest for the beginning of the year, or first half of the year, than the pandemic. So we are seeing growth that's positive, or we're seeing expansion that's positive. But the expansion rate in the first half is the lowest it's been in a while. So the business activity and new orders specifically, seeing that jump back up was very positive. However, business activities July reading was the lowest July since the pandemic. And average readings from April through July are lower than any year since 2009, other than the pandemic. So it's good to see that business activity pick up again, but it all consistently rings slow growth, slower growth than historically. And Dan, I mentioned this in one of the interviews as well. You got to believe that the manufacturing PMI, the contraction that it's been showing for quite some time, has got to start having some impact in services because of engineering services, construction, rental, leasing of equipment, all of those types of things, professional services. All of those have got to see the impact of reduced manufacturing activity. And I wonder if that's one of the things that really impacted those two negatives.
Yeah,
because it wasn't just consumer; it was across the board where we saw weakness.
Yeah, elaborate a little bit on that. I mean, I talked to Tony, your predecessor, a lot about the relationship. It's a good opportunity to get your perspective, based on your career in the services sector. Tony Nieves, used to like to say a lot of goods and components in the manufacturing sector end up as finished products in the services sector. So there definitely is a tight relationship in terms of success between one industry and the other. Just what does it look like, from your chair, in the positions that you've been in the services sector, that relationship between manufacturing and services, and kind of elaborate, just a little bit more on the relationship that we're seeing possibly right now.
Yeah, it's really good question, because you want to see how these things link together and maybe give you some insight into how you should behave from a purchasing standpoint and supply chain. For inventory sentiment, it continues to be, we've got too much. So when you think about services being more recent, more current month, what's going on today, versus manufacturing, how it's going to impact the economy in the future as those goods flow through supply chains, and almost 90% of our GDP. There doesn't seem to be a lot of pressure on driving more inventory. Inventories are lower, but inventory sentiment is still, we have too much. So that doesn't indicate a much more demand, on the manufacturing side, at least for services. So you look at aerospace, and I think Lockheed Martin hit an all-time high this last week. You look at kind of the turmoil in the world, there are manufactured products that are driving manufactured product demand. But you see utilities and construction in the services area are driving a lot of demand. You can't build anything without manufactured products and the inventory that's required to support that. Same thing with utilities. And we're seeing on electronic component side some shortage. We're seeing contracted labor and subcontracted labor, and then technical labor overall costs being up. So there's activity and there's demand for those resources going on. But I do have the concern as we're looking at inventories are too high, whether we're getting back to leaning out the supply chain. During COVID, it was, don't worry about it. Lean is a broken model. It doesn't work anymore. Just in time is a failure, et cetera. And now you talk to people across the board, even in emergency services, and they're saying, yep, we're getting pressure on investment and purchasing and capital, and we've got to reduce our inventories. So I wonder if that's playing into it as well.
Yeah. That's an interesting conversation to have. That's a trend that I've kept an eye on since the beginning of the pandemic. Everyone was kind of giving their last rites for just in time, and I was like, I don't know. It's a model that's had a lot of success through thick and thin for 40 years, and let's hold off on that a little bit. And that's starting to bear fruit since the end of the pandemic. So that was a good point. I wanted to ask you about employment, because that was kind of a pleasant surprise. But since we're talking about the supply chain and inventories, let's kind of skip down to supplier deliveries a little bit. That was an interesting reading also, with the faster reading. You kind of wouldn't expect that with some of the demand indexes, business inventory and business activity and new orders ticking up a little bit. just talk about that a little bit, and just give your assessment of the services supply chain at this point.
Yeah. So Dan, just as you're asking that question, I'm thinking, relatively new in the chair. What I haven't looked at is a month or 2 months removed, how that supplier deliveries relates back to business activity and new orders, because we saw last month new orders down, business activity down. You could think through a rationale where this month supplier deliveries are faster because new orders were down last month. So now orders are increasing. Well, the new business and the orders that you have now won't be delivered till next month, probably, or the next 3 months. So how do you look at that relationship of the new orders to speed of delivery? That to me makes sense, that we're having faster deliveries in July with lower volume in June. It allowed them to catch up. And then I think in some of the backlog, we saw a backlog of orders drop last month as well. So that seems to all tie together for me pretty well.
Yeah. All right. Yeah. On that employment, I mean, was that a little bit of a surprise? Not only in the sense that it was the first reading and expansion, and after last week's employment data wasn't great, to say the least. Was that kind of a surprise? And also kind of, if you want to generalize it, we are getting toward the end of the summer peak season. You would think that hiring might slow down a little bit, but the reading in July was a little bit more positive than maybe a lot of people expected.
Yeah, agreed. To me, it was a surprise. I can find my way to say, okay, after 1, 2, 3, 4, 5, was it 5 months of contraction, and some of the commentary around starting to replace open positions and fewer comments around reductions in labor. To me, that the commentary and the score and the index ties together pretty well. Mining, we saw an increase going from contraction to expansion territory with the overall services PMI, and in employment, they were the leading industry in terms of increasing employment. Accommodation and food services in July saw an increase in employment, the second highest industry, which you would expect during summertime. Probably see that type of thing. Construction was third, same kind of thing. You're in summertime, you make hay when the weather's good, and then transportation and warehousing bounced from contraction back to expansion this month, and so it would seem to me those are all very logical kind of things to be happening.
Yeah. Oh, well, let's look a little bit into this month. I know it's an interesting month in services. In the time that I've been following it, August. I mean, school is starting again or getting ready to start again in a lot of parts of the country. So that means vacations are going to taper off and summer experiences are going to taper off. And I know for a lot of companies and public entities, we're coming up to the end of the fiscal year and the start of another one. So any last minute spending or that's an opportunity to ramp that up. Just talk about what you might expect in August in the services sector, or is it kind of hard to project a little bit considering the recent ups and downs that we've had, at least with the composite index?
Yeah, so hard to predict, but whenever we've seen the three indexes, new orders, business activity, and employment, all positive, we've seen a pretty good month next month, 52 range or more. So if you look at the numbers from just this month's perspective, it portends a good reading next month, maybe in the 51 to 52 range again. That'd be what I'm expecting, although that's entirely my guess rather than something that's extensive data analysis. With hiring, you'd expect more demand in the services sector, and if that new hiring is really coming through in the services sector, I would expect to see additional expansion in the index next month.
Yeah. While I got you, I haven't had a chance to ask you this because you're relatively new as the chair. It was a question that, Tony, your predecessor, and Tim Fiore on the manufacturing side has gotten on from time to time. But, of someone, I think you had mentioned it in an earlier interview, and a couple of journalists also pointed it out, that the respondent comments this month were really tempered, or relatively calm, especially in comparison to some of the hair on fire that we're seeing with the markets this morning. Right. And just kind of made me think of just a general philosophical question that our chairs get from time to time: the value of the respondent comments. Since you've taken over, just how much weight do you put in them, especially in relation to the data? How much attention should they, be pointed to, and how big of a reflection are they in the general picture in terms of how the sector is feeling on a month-to-month basis?
Yeah, Dan, I would say I look at it very similarly to the commodities. Mm-hmm. When we say a commodities prices are up, prices are down, or they're short, we do that because we're getting multiple comments from respondents saying, and different respondents saying, that those products are either up, down, or in short supply. I use the same approach for the comments. If the commentary, we're seeing consistency, like we saw consistency this month around costs, not going up as fast, but continued pressure impacting demand, as well as starting to see summertime price increases coming through. That seemed to be a consistent, mantra. Some of the supply chain stabilization was also there. You didn't see a comment on interest rates this month because there was only one person that brought that up as a potential impact. So to the extent that you see lots of comments all across the board, not all that helpful. But when you start seeing, utilities and construction and retail all coming with the same commentary, you go, okay, well, that sounds like pretty much a wider economic situation than if it were just, a repeat kind of comment from one industry.
Yeah. Well, I know this is a question that, I regularly ask our chairs. I mean, I think I may have asked you this last month as well, and based on the degree of change that we had, and, the way that the markets are reacting to it today. I mean, if I'm a CEO, or I'm in the C-suite, what's the biggest takeaway that I should have from the Services PMI data today?
Yeah, so two things that I would have there. Mm-hmm. Costs are continuing to be an issue. They all know this, but costs are continuing to be an issue. In a slow growth environment where costs are an issue, you're going to see significant profit pressure. That seems to be very consistent with the last several months of labor commentary around pressure on labor and contraction versus this last month's expansion on labor. We're seeing inventories going down. So it seems to me, but still inventory sentiment being we have too much. So what seems to be coming out from the data, rather than advice to CEOs, is that many companies are working to restructure areas that were not external costs into compensating them in terms of their internal cost. With only slow growth, a lot of pressure on profit margin. The last, I'd say the last piece on that would be rate cuts, and to the extent that rate cuts can provide an economic advantage for impacting that profit margin, planning for that now, because all signs are that's going to come pretty fast and maybe more often, maybe as often as we had predicted beginning of last year, now towards the end of this year.
Yeah. Well, yeah, Steve, those are all the questions that I had. I mean, I always give you an opportunity to add anything that I didn't ask, or anything that might be important related to this month that we haven't talked about. Yeah, I'll give you an opportunity to do that. I mean, and this question just popped into my mind, and maybe you can put it in this context. I mean, we've talked in the last, 18 months or, and change that the manufacturing sector has, been in a consistent state of contraction, that, services, might be able to carry the economy for a time, which is obviously very important since it makes up almost 90% of US GDP. From that standpoint, is it getting a little bit harder for services to carry the economy, do you think?
I think awareness and sensitivity to what things are really costing are impacting the services area, based on mostly the pricing, pricing commentary that we're getting, as well as the cost commentary that we're getting. So we're seeing in the pricing index, prices are continuing to grow pretty fast. And then we're seeing on the cost side, a lot of commentary around embedded costs not coming down. People maybe were thinking lower inflation means lower costs, which obviously it doesn't. It just means a reduced rate of increasing. And with all of the pandemic legislation and injection of cash into the economy, I mean, that's dried up. A lot of the projects that were driven, a lot of the money is, not all the money, but a lot of the money has been spent. And as there's fewer of those dollars coming in and higher costs, I think it's a very, very good environment to be getting some rate reductions in September and further.
Yeah. Well, that's great, Steve. Thanks a lot. I really appreciate it. It was a great conversation, based on a very eventful day with the Services PMI data and how that fit in with, what's going on with the U.S. economy and especially the markets today. So we'll look forward to talking to you in another month.
Excellent.
But yeah, thanks for joining us today. And for more information, you can go to ismworld.org, where in a little bit you can read our roundup article that details a lot of what we've discussed here and how markets are taking the data. And if you'd like to be a part of the ISM Manufacturing Services or Hospital Business Survey committees that help compile data for the Report on Business, visit ismworld.org/join the panel for more information. We'll see you back here in a month's time, as I said, when we break down the August ISM Services Report on Business and manufacturing as well. So for Steve Miller and some people who helped us behind the scenes today, Christina Cahill and Jennifer Stevens, my name is Dan Zeiger, and we'll see you next time.